I would like to thank the China Green Finance Committee and the UN PRI for this invitation and for all your good work. It's a pleasure to take part in Climate Neutrality Week. With society placing a greater value on sustainability, almost 130 countries have now committed to net zero, including China. And more countries are recognizing that green stimulus is essential to a sustained recovery. Building a sustainable future will be capital intensive after a long period in which there's been too little investment in too many countries, and it will be job heavy at a time when unemployment is high. Now, countries are coming forward with ambitious 2030 climate plans, or NDCs. Last week at President Biden's summit, the US, the UK, Japan, and Canada all increased climate ambition. Major emerging economies from Korea to Brazil made important commitments, and China has shown incredible leadership. With President Xi's historic commitments to peak emissions by 2030 and to decarbonizing the Chinese economy by 2060 at the latest. China's 14th five-year plan includes headline climate and energy targets for 2021 to 2025, such as the reduction of carbon dioxide emissions per unit of GDP by 18% over that period, the reduction of energy consumption per unit of GDP by 13.5% over 2021 to 25, and the increased consumption of non-fossil fuel energy to about 20% of primary energy by 2025. And these were reinforced by President Xi's announcements at the summit concerning phasing out the reliance ultimately on coal-fired generation. All of these decarbonization efforts from all of these countries will require all forms of finance, public finance, private finance, and blended finance. And our focus for COP26 is for private finance, is to build a framework to ensure that every financial decision takes climate change into account. The momentum behind this agenda is now tremendous, and it'll be important that China is center stage to shape this new global sustainable financial system. It's a system that's built on four pillars. First, and most fundamentally, reporting. We have to improve the quantity, quality, and comparability of climate-related disclosures. We can do so by implementing a common framework built on making the Task Force for Climate-Related Financial Disclosures, or TCFD, recommendations mandatory. After all, what gets measured gets managed, and companies need to systematically report their climate-related financial risks, and auditors need to provide assurance on how companies take the impact of climate change into account. The TCFD is the gold standard for climate reporting, having been developed by the market for the market, and provides a comprehensive, practical, and flexible framework for corporate disclosure of climate-related risks and opportunities. The TCFD has almost 1,700 supporters in 78 countries. Companies with market capitalization of $17 trillion support the TCFD. And equally importantly, investors, banks, insurers, and pension funds responsible for assets of over $150 trillion are now demanding that companies assess the risks and opportunity that climate change poses to their business models, and that they disclose this information in line with the TCFD recommendations. It is therefore very encouraging that the PRI are participating in a UK and Chinese government-backed pilot on climate-related and environmental risk disclosure aligned to the TCFD, the UK-China Climate and Environmental Information Disclosure Pilot. I remember when this was announced at the 9th UK-China Economic and Financial Dialogue back in December 2017. This initiative has established a leading group of 10 UK Chinese financial institutions to advance climate reporting practice in both of our countries. According to the PRI's progress report, participating institutions have found that TCFD disclosures have raised their preparedness for climate and other environmental risks. And this welcome initiative by the PRI will help Chinese firms prepare to transition to mandatory reporting requirements that will embed the TCFD framework. I also want to commend China's efforts in promoting transparent sustainability disclosures by the private sector, and especially the TCFD, thanks to the Sustainable Finance Working Group of the G20 that is co-chaired by the People's Bank of China and the US Treasury. In order to truly make climate-related financial reporting comparable and comprehensive, it needs to be mandatory. And to that end, we're asking countries to publish pathways to show which authorities in their respective jurisdictions will be responsible for implementing these reporting rules, the sectors to which they will apply, and the timeline over which they will become mandatory. Ahead of COP26, we'll be asking countries, including China and other G20 members, to sign up to a joint statement on mandatory disclosures that commits signatories to endorse these recommendations of the TCFD, to aim to implement the TCFD disclosure obligations across the whole of the economy, with the ultimate goal of fully mandatory regime. And also, it's important to support the global standard setting of the IFRS Foundation's new Sustainability Standards Board, and committing to exploring avenues for domestic adoption of future IFRS Sustainability Standard Board standards when they come in to being. We therefore urge you to support the COP26 joint statement on mandatory disclosure and to embed TCFD into future corporate disclosure requirements and promote those international pathways to mandatory and aligned disclosure. That's the first and in many ways most fundamental pillar of our COP strategy. Turning quickly to risk, ensuring that the financial sector can measure and manage climate-related financial risks requires the assessment of both physical and transition risks. Those physical risks arise from the increased frequency and severity of climate and weather-related events that damage property and disrupt trade. Transition risks arise from changes in climate policy, from new technologies, and changes in market sentiment as we adjust to a new net zero economy. These will affect virtually every business in every sector in every country. Now, when it comes to managing climate-related financial risks, disclosure needs to go beyond the static, in other words, a company's current carbon footprint, to the strategic, with their plans to manage down their emissions. China, in many ways, has led the work on climate-related financial risk assessments. The Network for Greening the Financial System was co-founded by the People's Bank of China and has grown into an alliance of over 80 central banks and supervisors representing countries who account for over 3/4 of the world's emissions. The NGFS is working to improve banks' understanding of climate risks that lie ahead, including through the use of new NGFS climate scenarios. From country-level assessments to systemic assessments of climate risks, central banks are also progressing with climate-related stress tests. 18 central banks have committed to running these stress tests, which will reveal which financial firms, and by extension, their clients, are well prepared for the transition, and it will expose those that are not. I would like to salute the People's Bank of China, who in 2016 published guidelines for establishing the Green Financial System, a series of policy initiatives to support and incentivize green investment, including PBOC relending operations, specialized green guarantee programs, interest subsidies for green loan supported projects, and the launch of a national level green development fund. The PBOC guidelines specifically encourage commercial banks and other financial institutions to evaluate their loans and their exposures to assets in high environmental risk areas, and to analyze both the credit and the market risk in a quantitative way. China may now wish to complement this work with steps to enhance risk management across the financial system, including supervisory expectations, stress testing using those NGFS scenarios, integration into monetary policy and portfolio management, and its own TCFD disclosure. Turning to the third pillar, returns, helping investors to identify the opportunities in the transition to net zero and reporting how their own portfolios are aligned to the transition. This third pillar aims to find also the opportunities in the transition to net zero. Company net zero transition plans will be critical in exposing how those businesses will seize those opportunities as they respond to changing conditions. On the road to Glasgow this November, investors are clarifying their expectations for company transition plans, and best practice is emerging for plans with Scope 1, 2, and preferably Scope 3 targets, plans that balance absolute emissions reductions with the appropriate use of offsets, plans that are governed at the board level and that are tied to executive compensation. But over time, investors won't just judge company transition plans. They too shall be judged. Investors should disclose how closely their portfolios are aligned with the transition to net zero. Some of the world's largest and most influential investors are now making this commitment. Just last week, on the eve of President Biden's climate summit, we launched the Glasgow Financial Alliance for Net Zero, or GFANZ. GFANZ brings together the world's biggest banks, its biggest asset owners and asset managers and insurers into the race to zero, which is the gold standard for commitments to sustainability. GFANZ was launched with over 160 firms responsible for assets of over $70 trillion and with one shared mission, accelerating the transition of the global economy to net zero emissions by 2050 at the latest. Unlocking the systemic change for net zero requires ambitious and coordinated action from across the financial system, and that's why GFANZ will act as a strategic forum to ensure the financial system works together to broaden, deepen, and accelerate that transition. This is the breakthrough in mainstreaming climate finance that the world needs. A crucial part of GFANZ is the formation of the industry-led and UN-convened Net Zero Banking Alliance. This alliance comprises 43 banks from across 5 continents with responsibility for assets of over $28 trillion. For GFANZ to play its global role, we'd like major Chinese financial institutions to join and help shape this agenda. Turning to the final pillar, mobilization. Increasing private financial flows to emerging and developing economies will connect available capital with investable projects. But for that, we need new market structures. One of the most important is a credible, transparent, and large-scale voluntary carbon market. And we're making considerable efforts to develop that through a new private sector group of experts under the Task Force on Scaling Voluntary Carbon Markets, chaired by Bill Winters. They published a blueprint for this market, and it's a market that will be complementary to absolute emission reductions. Those offsets will likely represent about 10% of total net emission reductions over the next decade, but that's still enough to create a market that could reach $100 billion a year in transactions. Markets of that scale will be catalytic, including helping to scale up low emission technologies and activities. As Bill Gates has said, these markets will help with the essential breakthrough technologies such as hydrogen, direct air carbon capture, and sustainable aviation fuel that are needed to get us ultimately to net zero. The market for offsets will be cross-border. Most of the companies making these net zero commitments are in advanced economies. They'll be looking for high quality, high integrity projects, most of which will be in emerging and developing countries. And this market will have co-benefits. These projects have the potential to improve biodiversity and the achievement of other sustainable Sustainable Development Goals, all being rooted in high integrity, highly transparent carbon reduction projects. So to conclude, the transition to net zero is fast becoming one of the most important driver of investment. This new sustainable financial system is being developed on the road to Glasgow. China's work, the UN PRI's work, is essential to building the foundations of this market. And I look forward to your continued leadership and working closely together as we build the financial system the world needs. Thank you very much.